How do you make money in a capitalist system? Well, in the stock market, it's very much about information asymmetry. You need to find data somewhere that tells you an asset class or a business is a good buy. When you buy a stock, you're buying confidence into the future productivity and existing productivity of a business. When you buy real estate, what are you buying? You're buying stability and shelter for your family or for another family, but you're also buying something else. You're buying your confidence in a location or a neighborhood that asset exists within. The question that I'm asking you right now is, how do you analyze properties that aren't in the location that you exist within? How do you analyze properties across the country in different places to be able to find investments that are good that aren't in places that you're familiar with? As real estate investors, we do this by calculating a rate of return, and most often that is the cap rate or capitalization rate, which is net operating income divided by the purchase price of the property. I'm very excited to show you a report that I've been working on where we basically calculated the cap rates of different properties in different markets across 21 cities in Canada, across all 10 provinces. Let's say you buy $1 million house, which is pretty close to the average home price in Canada. On that transaction, there's a premium of about $50,000 just for the access to information that a real estate board or real estate professional has that the regular consumer doesn't have. And that difference of information allows them to broker a transaction. If you follow me, you know that part of my mission is to bring more transparency to the real estate industry. And the reason I want to do that is I want to make sure that the average consumer of real estate, buyers and sellers, get their money's worth out of the real estate transaction. The difficulty in finding information in Canadian real estate is so bad, in fact, that it was painful for me to make this report. And I had a team of a couple of people working on it. It took us months to put together all of these data points, and now that we have them, we're planning to release this on a monthly basis. But we analyzed hundreds of properties across Canada using Landlord.io's deal analyzer tool that allowed us to get through a lot of those really, really quickly. And basically what we did was we created a spectrum of rates of return across different cities in Canada. So let's take a look at the report. Let's open this up and we'll start on the page with the heading chart, page number 6. This chart shows us the approximate housing market investment returns, or the rent to price ratio of different cities across Canada. So the bottom bound of the bars on the chart is the lowest cap rate that we could find in that market, and the top bound of the bar on the chart is the highest cap rate that we could find in that market. And then the triangle that you'll see is the average rate of return, so the rent, which is a function of the rent to price ratio and the average of all of the cap rates that we could find within that market. We also put the red line, which is the risk-free rate on that chart, which shows you how each of these cities rank above or below where you could get a return by just investing your money into a GIC, or a guaranteed investment certificate, which is basically a risk-free way of generating a return in the market right now. Okay, so if we look at the top end of the report, the 3 highest performing markets on a return on investment basis were St. John's, Newfoundland, Edmonton, and Regina, Saskatchewan. I had this sneaking suspicion that going to come out as a high rate of return market just based on conversations with individuals in the industry and investors who are putting capital into those markets. One of the challenges with St. John's is that it's also the only province that is expected to actually contract in population over the next 30 years in Canada. And that's because it's an aging population and they're not seeing a lot of immigration to replace the population that's dying off in Newfoundland. So while Newfoundland is a great investment on a yield basis, it's not an exceptional investment potentially on a growth basis because of that long-term factor of population contraction. The province might not stay in a state of excess demand like most of Canada, and that's what we know drives the price up in Canadian real estate. Talking about those fundamentals of population growth in Canada, one of my goals as a commentator in the real estate space, and why I try to analyze yield of real estate rather than price of real estate, is because I think the real estate market has really been broken by the information asymmetry that I've mentioned a number of times. But the reason that I put together this report is to give people the tools that they need to make safe real estate investments in Canada. We're going through a major downturn in Canadian real estate right now. This is likely a once in a lifetime cyclical event. The last time we saw a major counter cycle in Canadian credit and Canadian real estate was in the 1990s. In 1989, prices peaked and they dropped until 1994. If we saw something similar happen in Canada today, that would present a lot of an opportunity for the layperson to invest in real estate. It could be what many are calling a once in a lifetime buying opportunity. I don't say that to try and give people a sense of urgency to get into the market, because I don't think there should be a sense of urgency to get into the market. What I think my goal is, or my function is as a real estate professional, is to give you the full scope of information, which is what's the best case and what's the worst case scenario. Best case scenario doesn't require a plan. Worst case scenario does require a plan. So if we think about the worst case scenario and we analyze what the worst case scenario looks like, and we find investments that make sense based on the worst case scenario, we still want to buy it if the worst case scenario happens. I would still be happy owning this asset if the worst case scenario happened. Now you found yourself a good real estate investment. We can't do that from my perspective without understanding what the return on investment of that asset is. And I wanted to give people a starting point of where they can start looking for investments with good rates of return across different Canadian cities, because it's not a piece of data that we actually have available for regular Canadian real estate investors. Let's say you want to buy an investment property somewhere in Canada. You believe in Canadian real estate. You qualify for a mortgage in Canadian real estate. But with where interest rates are right now, the property has to have a certain rate of return to be able to cash flow the mortgage. You don't want to be losing money every month. You don't want to be paying money every month to hold an investment. That's not an investment. That's a liability. What this report does is it allows you to succinctly look at different cities and the rates of returns that you might be able to find in those cities to give you a starting point in where you might want to dive in to further research for real estate investment.
But you don't want to just be cash positive. You also want to make the most money as possible.
Sometimes. Some people, it depends.
Not all landlords want to.
Well, no. So it gives you a data point where you can say, have always been interested in St. John's as an example, and now that I know that its returns, its rate of return, or its return on investment will fulfill my goals as an investor, that's a market that I'm now interested in actually pursuing. It helps you to qualify or disqualify markets based on the quantitative metrics. The qualitative metrics are something that you have to decide for yourself. What cities do you feel that have strong future growth potential? What cities do you feel have good employment prospects, are recession proof? Which cities do you like or do you believe in the future of? Those are decisions that the investor typically needs to make on their own.
It's much like deciding if I'm going to put my money into oil and gas versus medical industry.
Absolutely. You can actually get exposure to real estate assets. You can get exposure to different asset classes through real estate. So if you believe in lithium ion mining, you can actually buy real estate in the city closest to the new lithium ion mine that is going up. Or a lot of individuals that I know who are bullish on nickel and gold in Northern Ontario were buying rental properties in Kirkland Lake as an example, and they get a lot of exposure from that industry.
Or if you believe in triplex and duplexes versus single family homes.
For sure, yeah. I mean, if you absolutely, that's condos. But yeah. So, and some people do believe in condos. I mean, one of the interesting parts is you can actually make demographic plays as well. Like you can say, I think that baby boomers are going to be the next big demand pool for tenancies and for purchases. So in order to get exposure to that, I'm going to buy a lot of bungalows because they don't want stairs, or I'm going to buy a lot of condos because I feel that boomers are going to live in condos. So you can actually make geographic or demographic plays or industry-based plays into real estate. So to put together this report, we grabbed data from a variety of sources. Most notably, we used Canadian Real Estate Association's Data Distribution Facility, or DDF. We use their HPI, or House Price Index. We also use rentals.ca and rentpanda.com to gather rental or rent price data, so the monthly rental rates. We also use realtor.ca to look through a bunch of listings, and then in order to actually compress all of that information and do the calculations necessary to get a ton of cap rates across the country, we couldn't have done that without Landlord.io's deal analyzer tool, which basically allowed me to crunch hundreds of cap rates in a very quick period of time. If I was, and I know, given my background working for institutional real estate and working in the commercial real estate space, you need to be looking, acquisitions departments at these institutions are looking at hundreds, if not thousands of deals before they find a good one. So you have a 1 in 100 chance of finding a good deal, let's say. I personally don't have the time to go through 100 deals using traditional methods. And if you are a professional, typically the best expenditure of your time is to do your job, or other ways that you can actually monetize yourself. And you probably don't have the time to do it either. So what I advise people to do is find the simplest way to concisely make decisions. And this report is designed to make the decision of, okay, what area do I want to invest in? And then the second order effect of that is, once I've decided, okay, I really like St. John's based on this report, how do I go through and look at a bunch of deals in St. John's very quickly? And I can tell you, because we did it to come up with the data points in this report, St. John's took me about an hour and a half to go through every multiplex in that city using Landlord.io, basically quickly plugging in the rent, quickly plugging in the value of the property, and spitting out a cap rate, putting that data point into our spreadsheet for the report. So before I wrap up here, I want you to think about how the financial markets have changed so much over the past decade as a result of us entering into this new information age. Information has never been easier to get around certain financial assets, and it's allowed new individuals to capitalize, new individuals to enter the market, new individuals to make meaningful change in those industries. Real estate is still a very archaic industry in that respect, and one of the things that this report does, and a lot of these tools do, the tools that I've mentioned throughout this video, it helps us to break down that barrier a little bit. It helps us to get closer to the flow of information, the information advantage that you're starting to see creep into or flood into some other financial markets is creeping into the real estate space. And I want to be able to put investors and end users, especially millennials who have been disenfranchised by the real estate industry for the past 2 decades. I want to give millennials the tools to put themselves at a competitive advantage, or to have a competitive advantage in playing within that asset class over the next decade, because this might be our last shot. Yeah, so get out there and find those tools and make them work for you. We don't have teams of analysts sitting around. We aren't institutions. And in a lot of cases, even in the single family space, we're competing with institutions. So whatever we can do to give ourselves a marginal increase in efficiency as millennial real estate investors, as millennial home buyers, even regular purchasers of real estate, consumers of real estate, we need to do that. If you have any questions about the report that we've put together, or if you want help on calculating a cap rate, just send me an email in the email below, and I'd love to chat with you. Until next time, my name is Daniel Foch. I am a real estate broker and host of the Canadian Real Estate Investor Podcast. I'll see you next week.